Pozdravljeni, sem Marja Milič in poslušate MoneyHow, prvi podcast o upravljanju denarja pri nas. V tokratni epizodi imamo enega posebnega gosta in sicer urednika, odgovornega urednika Investopedije Caleb Silver, ki je hkrati tudi ustvarjalec podkasta Investopedia Express. Na začetku njegovega podkasta je tak zelo lep poetičen uvod, ker v bistvu predstavi, kako lahko je v bistvu samo dogajanje v gospodarstvu na finančnih trgih ena velika, lepa poezija. In to on zelo lepo tudi v besedi. Tako da zanimiv pogovor je bil z Calebom Silverjem. Je pa ena zadeva mogoče, ki bi vsem rada izpostavila na začetku, pa ne bo predolg uvod. In sicer omenjal je, da glede na to, da je zelo zaposlen, da se precej zanaša na finančnega svetovalca, bi pa rada tukaj vsem poudarila, da je finančno svetovanje v Ameriki popolnoma drugače urejeno, kot je finančno svetovanje v Sloveniji. Tukaj pač je treba vedeti, da so zelo velike razlike. Pri nas finančni svetovalci niso neodvisni, ampak v bistvu so zastopniki in prodajalci finančnih produktov. Ponavadi velikokrat celo se zgodi tako, da v bistvu prodajajo produkte, kjer dobijo najvišje provizije. Tako da to je ena taka velika razlika, na kateri bi vse mogoče opozorila. Tudi to sem ga vprašala. Na koncu ameriška borza obstaja 200-300 let, v Sloveniji recimo 30 let, dobrih 30 let. Ne. Tudi to je pomembno, kdaj, kje smo bili rojeni in tudi to nekako oblikuje našo investicijsko pot. Sva se pa pogovarjala 7. avgusta, se pravi, to je bilo le nekaj dni po tiste malo večji korekciji, ki se je zgodila na borzi. Takrat smo videli 5% oziroma 5% dnevni upad, ki pa je v bistvu ni tako običajen, ampak takšni upadi pa so običajni. Tukaj se pogovarjava tudi o razlikah med zlomi in pa popravki. Videli smo, borze so potem poletele do novih rekordov in zdaj beležimo že kar nekaj časa, nekaj tednov, praktično kontinuirano rast na ameriški borzi. Tako da, ja, borza je zanimiv parket, ker se veliko stvari zgodi, lahko imaš vzpone, padce, skratka nikoli ni dolg čas. Poslušajte podcast, prosim, sporočite mi preko kateregakoli kanala, ali je to TikTok, YouTube, Instagram, Discord, kaj si mislite o tem pogovoru, če imate kakršnokoli dodatno vprašanje, mi tudi prosim pošljite, tako da prijetno poslušanje. Caleb, it's wonderful and it's my honor to have you on our show. I'm a huge fan of your show and many of our listeners are your listeners as well. So this episode will definitely be a delightful surprise for them. So thank you.
It's an honor to be with you. Thank you for having me.
So before we dive into the recent market correction, I want to ask you about the financial poetry that you recite at the beginning of each episode. It's actually a unique and captivating way to summarize current events in the financial market. Do you have any special events that inspire the most? Maybe something dramatic like, I don't know, crashes or black swans?
Yeah. No, I'm just a huge hip hop fan and a rap fan, and I constantly have it in my ears when I'm skateboarding around from studio to studio or coming into work. So I've been a hip hop head for a long time. So the lyrics are in my head. And of course, I spend my days and nights digesting business news and research. So it's all kind of spinning around in there. And the way for me to get it out is through that little freestyle at the top of every podcast of the Investopedia Express. I started doing it. I thought I would do it once. And I can't stop. And I'm 200 episodes in, and maybe one day I'll stop, but not now.
Please don't stop. No, never. So you skateboard. It's a huge business. I was like watching the Olympics yesterday. Wow, the girls are fantastic in skateboarding. They're unbelievable. They're like 11 years old and they're winning gold medals, Olympic medals. It's like fantastic.
They're fearless. They're unbelievable. They keep getting younger and keep getting more and more daring. I'm so excited that skateboarding is an Olympic sport. Whoever thought of that I'm sending them a case of wine. That was a great
case of wine or something else. Maybe marijuana. It's legal in New York. When I was in New York, like 3-4 months ago, it was like I was like high all the time because everything, the smell of marijuana is like everywhere.
Yeah, well, they used to be called Amsterdam here. They might as well call it the New Amsterdam again.
The New Amsterdam. Yeah. Let's talk about the recent market correction. It was approximately 5 to 8% in the major indices. I made a clip about it, and you did the same similar thing with the helmet on your skateboard. We both published on social media. I don't know what kind of reactions you received, but I received several questions, likely from newbies, from new investors regarding the term correction. Some perceived it more like a crash, but 5 to 10% decline in the stock market isn't uncommon. It typically, happens once or twice per year.
Yeah, a correction technically is a 10% drop from recent highs. So we did see that in the NASDAQ. We saw it definitely in the Japanese stock market, the Nikkei 225. That actually went into a bear market for a few minutes there and came back. The Russell 2000 had a correction. Those are the small stocks. But the S&P 500 was down at its lowest level at around 8.5%. And guess what? It's still up 8.5% so far this year. So financial media and certainly on social media, people like to call it a crash. It's not a crash. A crash, for anybody listening, is a 50% decline in an index, a security, the stock market itself. So we haven't had one of those since 2008, 2009. And the one before that was in 1999. That's a crash. And that is devastating. A correction is, like you say, that happens once a year. The stock market usually corrects on average once a year. It usually goes into a bear market every 3.5 years. That's a 20% decline from recent highs. So we haven't had really either here in the U.S. quite yet. And guess what? We're talking on Wednesday. The stock market's recovered almost all of its losses and heading higher. We'll see if that conviction stays with investors.
Some savvy and bearish investors are predicting an unprecedentedly brutal market crash. And during the recent correction, we saw investor getting nervous. The VIX index, recognized as the world premier gauge of U.S. equity market volatility, soared to 60-something points intraday, pushing us into extreme fear territory by the end of the day. So what are your thoughts on current investor sentiment in the market?
Yeah, well, the VIX, or volatility index, measures fear in the market by looking at the volume of options trades, particularly put options. These are bets against the market over the next 30-day span. So if you see a lot of people making bearish bets against the stock market through the options market, the VIX will rise, and rise it did. But guess what, Maria? It hadn't been alive. It'd been asleep for the last 2 years. We hadn't seen the VIX pop above 20 in a very long time. So the fact that it came up when it did, there was a lot going on and many reasons to sell and a lot of fear in the market. Some of it was because of some soft economic data here in the U.S., a softer than expected jobs report, a rise in the unemployment rate, which always gets people thinking and fearing about a recession, but also some softer manufacturing data. At the same time, there was this big unwind carry trade happening where for a long time, many, many months, if not over a year, a lot of investors were borrowing Japanese yen because it was pretty cheap and pretty stable. I don't know if you know, but I know a lot of people that went to Japan in the last year because the yen was so cheap. They were borrowing yen to buy stocks or other currencies. They were buying big tech stocks with it. So as soon as the Bank of Japan raised that interest rate last week or over the weekend, it scared a lot of investors. They had to cash in their carry trade bets and sell their big tech stocks. And we know big tech stocks have been driving market gains here for the past year and a half. So as soon as that happened and you saw a big sell-off in the most popular names, well, that just turned into an overall sale. And it was a sea of red across the stock market Friday and Monday.
Mm-hmm. So now you're talking about carry trade strategy. Obviously, this strategy is used by more educated investors, I think. Is that the case? That's
absolutely right. And in individual investors, retail investors like us and our listeners, we particularly don't mess with that type of a trade. You know why? Because you have to monitor it super closely. I mean, the Bank of Japan raised interest rates. It was not like they telegraphed it. So that took a lot of people by surprise. Well, if you're a Forex trader or if you're borrowing a foreign currency to then buy other securities with it, you have to watch the Forex market 24/7 because it trades 24/7. I think a lot of people were taken by surprise by that, which led to a sell-off. And you know how it is around here. When there's blood in the water, everybody starts selling. Everybody fears the worst. And I think a lot of people thought we were heading into one of those dizzying tailspins in the stock market that wiped off 20% of recent gains. That hasn't happened, at least not yet.
Now that you mentioned blood in the water.
Yeah.
You mentioned blood in the water. We have to talk about that. You know the saying, bulls make money, bears make money, pigs get slaughtered. So maybe to clarify to our listeners, Investopedia defines a pig as an investor who is greedy, having forgotten their original investment strategy and they're focused on securing unrealistic future gains.
Yeah. Well, the stock market is full of great metaphors that involve animals, whether it's a dead cat bounce or pigs getting slaughtered. So yeah, that's investors who got over greedy, and went outside of their strategy because they wanted to keep up with other investors. That's that FOMO, fear of missing out trade. We saw a lot of that. And for a very long time, these big tech stocks, and we're talking about the Magnificent Seven, the FANG stocks with Microsoft as well, they became safety trades for a lot of investors. Why? Because they kept growing their profits and they just kept going up. They became, and they still are, the biggest companies in the world. And when investors were looking for a place to park money, when they got tired of 5% in the bank, they kept piling in to the big tech stocks, and people overdid it, right? They overate. And not just tech stocks, AI related stocks, utilities that supply power to AI companies. So everybody got involved, and it was a little bit greedy and slightly piggish. So pigs do get slaughtered when the tide rolls out and everybody starts selling. People that were holding the bag and got in late, they usually end up faring the worst. And we see this in every market cycle. We saw it with the meme stocks, right? We saw it with the internet stocks in 1999. We saw it with telecom in the 80s, railroads in the early part of the 20th century. This is nothing new. We're just animals, and we have animal spirits, and they tell us to be fearful. When we get, things get a little scary, we get a little too scared, and we get too greedy when things get a little too good. We just have a hard time controlling our emotions, which is why as an investor, you have to understand your own risk appetite. Don't do what everybody else is doing. Do what you're comfortable with and do what works for your strategy, because your strategy and my strategies are very different because we have different goals at the end of the day.
But you know how we are. We are like copycats. We like to copy others, sure. Especially, investors who are very experienced. You mentioned dead cat bounce. Do you think that's a possibility? Do you see that scenario happening?
Yeah. First of all, I don't even know where that term comes from, but I did a little research because I had a guest on my pod. He said that was his favorite term. It's a morose term, thinking about a dead cat bouncing, but I think it comes actually from World War I or II when the pilots were flying around and they were deciding if they were flying high enough that a cat could bounce if they dropped it out of their plane. It, of course, got adopted by Wall Street. And that means, is this just a bounce off of a big sell-off that doesn't last very long, that doesn't have staying power? And that's the thing I'm watching really closely here. We've had closed higher the last couple of days, but we haven't closed at session highs. So while there's been a recovery in some of the indexes, they haven't closed up 800 or 900. They've kind of sold off towards the end of the day. Not crazy to see that. I just came from the New York Stock Exchange right before I got on your podcast, and there was a lot of excitement because this is like 2 days in a row of a rally off of lows. But the conviction just doesn't seem to be there. And if you watch those indexes closely, you will see the trade-off starting to happen. People get into the trade in the morning, and by 11 o'clock, you'll see the market start to peter out a little bit as people start to sell off some of those gains. They made some of their money back. And don't forget also, so many investors have made a lot of money investing with these big mega cap tech stocks, the semi stocks, the AI stocks. Not crazy to see them taking profit right now, especially with an uncertain political future facing the United States. We have a big election in November. There's questions about the tax rate. What will happen? Will the Trump tax cuts of 2017 get extended? If so, what does that mean? If not, does that mean higher capital gains taxes? Does that mean higher corporate taxes? So you can understand why people might want to take some money off the table.
Mm-hmm. But pullbacks are actually an investment opportunity, and the research actually shows that since 1980, the S&P 500 index has generated a median return of 6% in 3 months that followed a 5% decline from a recent high, according to Goldman. So many investors were waiting for this dip. Many investors actually bought the dip, Did you maybe participate in this dip? Did you buy anything in this dip?
Yeah. I'm a regular investor, so I make regular purchases either through my 401k, through work, where I'm just a passive investor, but I'm very selective about what I invest in. And I work with a financial advisor and planner who manages my family's money. And we have a rules-based plan, right? We don't do anything because there's a dip. We have actually a strategy that we follow that is based on rules and evidence. And when certain conditions are met in the market, we rotate. We rotate into either safer assets if it gets scary, or we rotate a little bit more aggressively when things are cooling out a little bit. We don't make decisions based on the day-to-day ups and downs of the market. And I certainly don't do it. I'm the editor-in-chief of Investopedia. I got to go out there and talk on TV about these things. So I don't want to be encouraging people to do what I do or make moves. I've also learned, and I've been at this for 30 years, that I am a terrible market timer and a terrible stock picker. So I don't even do that anymore. Every time I've done that, I've lost a lot of money. I leave it to the pros, but the pros, my pro, and I and my wife, we actually have rules. So we don't get too ahead of ourselves and we don't let our animal spirits take over. And so far that served me really well.
Yeah. The industry of financial advisor is very developed in US. In Slovenia is totally different things.
Yes.
So, everybody was talking about Warren Buffett and his holding Berkshire Hathaway has like $280 billion in cash. After selling 50% of Apple's share. Is cash king?
Cash is king if you're Berkshire Hathaway because they need to make big purchases. And Warren Buffett has said for years, and Charlie Munger, rest in peace, before he passed away, they had a problem spending that money. They couldn't find acquisition targets or companies they wanted to buy that were big enough to move the needle. But if you look at what they've done over the past few years, just let's talk about the last few weeks or the last few months. They've cut their position in Apple by half. They were the biggest shareholder of Apple. And if you see what happened to Apple's stock, that may have something to do with it. When people hear that Warren Buffett's doing something, he's somebody that a lot of people like to play copycat with. There's that. Sold a lot of his bank stocks, loaded up on Occidental Petroleum, and invested heavily in the Japanese stock market, not just the Japanese stock market, but the actual exchanges in Japan, because maybe they've had a sense that volatility was coming their way. Those have been excellent bets, but you don't see Berkshire Hathaway buying mega companies anymore because they can't find one that fits Warren Buffett's recipe for what's the perfect company. The perfect company is a great business, undervalued, run by extraordinary managers, but it's got to be big enough because Berkshire Hathaway is a massive company right now where the returns from owning that equity or from owning that company outright actually move the needle for Berkshire, which really makes most of its money through insurance and energy.
Mm-hmm. One of our listeners commented that the diversification is for people who don't know how to invest. What is your Warren Buffett actually said that. What do you think about that? Because as a retail investor and a person with a regular job, I don't have time to read all the financials.
Of course not. Of course not. So there's different forms of diversification, right? The classic diversification that we often talk about here in the U.S., especially for investors as they get older, is a 60-40 portfolio, 60% stocks, 40% bonds, right? When the stock market gets a little crazy, or when it starts to fall into a tailspin, bonds usually perform well. Well, that kind of broke apart during the pandemic and after the pandemic. Not only were stocks going down, where bonds were going down at the same time. You rarely see that happen. And that was because our economy was completely dislocated. Well, now you're seeing that normalize a little bit. So that's the classic definition of 60-40, but there's all different types of ways. I don't buy personally individual stocks. Why? Because I'm a terrible stock picker. And also I have to go speak about them. And I don't want people to think I'm front running. But I'm also terrible at choosing them. My timing is terrible. But I do buy ETFs, exchange traded funds, which is a way of diversifying. So I believe that semiconductors are going to be here for a very long time. We're going to be using them for the next 50 to 100 years at least, right? I believe in that sector. I wasn't smart enough to pick NVIDIA. I wasn't smart enough to pick Micron or AMD or Supermicro, which is not really a chip stock, but I wasn't smart enough to make these individual stock picks. But I was smart enough to buy an ETF that holds all the major semiconductor firms, right? I believe in the future of AI and robotics. I'm just not smart enough to pick the right companies, nor do I have the time. So I buy exchange traded funds that hold the top AI and robotics companies because I think that's going to be here with us for a very long time. Same thing with Bitcoin. I own some Bitcoin, but I also bought through my advisor the Bitcoin ETF because I wanted to be able to buy that spot price at various prices. And I don't have the time to sit here and watch every tick of the market for Bitcoin, which PS trades 24/7.
Yes, it does. What about Ether ETF?
What, excuse me? I haven't touched the
Ether.
Ether ETF, but I have bought a lot of Ether, and I started buying that several years ago. So I just like to buy Ether. I think it's a smart coin. The Ether ETF, even with the Bitcoin ETF, my good friend Tyrone says it this way. He says, it's like putting a Ford Fiesta engine in a Ferrari, right? You want Bitcoin to just run. You want Ether to run. It's a much smarter coin. It's got a much more, bigger use case, I think, than even Bitcoin does. So I don't want to buy an ETF that wraps that spot price and curtails where that price could go. It'll eventually catch up to it, but I prefer to own the crypto itself.
What about Solana?
Solana, I don't understand well enough to buy. And every time I think I do, something happens with it that just confuses me. So I'm like Warren Buffett a little bit in that I buy what I know, what I understand. I understand Ether's role and Ethereum's role on the blockchain. I understand Bitcoin, but I don't understand Solana enough to really make that purchase. That said, there is a very small percentage of our portfolio is in a crypto related fund. And I'm sure in that fund, my advisor and the people he works with have made some purchases of Solana and other coins that I'm not aware of.
Okay. I was talking to an analyst, and he told me that he still thinks that valuations are still high and the market is still overpriced. And so he's still like waiting for more generous discounts. And also I was reading this morning, I think it was on Bloomberg web page, Max Gochman from Franklin Templeton Investment Solutions said, it's like seeing a designer bag you wanted marked down 10%. It's still very expensive, but you can tell yourself it's a deal. Do you think markets are still expensive, overpriced?
Yeah. Well, it depends what metrics you look at, right? If you look at the PE ratio of the S&P, if you look at the PE ratio of the bigger stocks in the S&P 500, that's still north of 20. It's like 21, 22, the forward price to earnings ratio. Now, back in the internet.com bubble, we had the price to earnings ratio of the hottest stocks in the market up in the 30s and 40s. So relatively and historically speaking, it's pricey. It's not crazy expensive right now. If you look at the S&P equal weight, right? If you just weighted all the companies in the S&P 500 equally, not market weighted, but equal weighted, that forward PE ratio is around 18. Very normal, very reasonable. The question is, what is the alternative? And for a very long time, we were in this state when interest rates were down near zero or very low, where it was what we call TINA. There is no alternative. TINA. There is no alternative. Well, guess what? We had inflation. We had the pandemic. We had inflation. They ratcheted up interest rates to the highest levels in several decades. And all of a sudden there were alternatives. The alternatives were in the bank. 5% in the CD, 5% in the money market, and a high yield savings account. You have options as an investor. So when you look at valuation, you have to look at where else could I get these types of returns for my money, right? In companies or securities where there is actual growth, right? There is no growth in the bank. 5% is great, but it gets really boring for people whose job it is to make money with money, right? So it's expensive, but sometimes there is no better alternative than the stock market to put money to work to generate alpha. And I think that's what you see a lot of the time as well. It's like, I could do other things with that money for the near term, but I know that I'm being judged as a professional investor, not me, but those who work in institutions around the world on your quarterly returns. So they don't want to be out of the market when the market starts to take off again.
Mm-hmm. Everybody now is asking when we are going to enter the bear market, because some analysts also say that it's too early to jump back into the US stock market, and some say or predict that S&P 500 that we are going to see correction in October, and that S&P will like drop to 5,000 points.
Yeah, it could. I mean, I wish I knew. If I knew, then I would be actually making some futures bets, but I don't. But I do know this. Bear markets happen. They're a part of the market. They are not a bug. They are a feature, and they occur about every 3.5 years. The last bear market ended in October of 2022. So this bull market is not even, it's just barely halfway through a normal bull market cycle. The thing that's weird, and I think you notice this as well, is that cycles in the market have come a lot quicker than they used to, right? You could go 10 years without a bear market back in the day, but they've been coming fast and furious when you look at it in historic terms, right? 2022 was a bear market. We snapped right out of it into a bull market, and we're, again, halfway plus through it. That doesn't mean it has to go for 3.5, 4 years. It just means it's relatively young, but we've gone in and out of these cycles very quickly. And some of it is the role of monetary policy and the lack of moral hazard, right? If you think, and everybody, as soon as the market started selling off this week and we got that ugly jobs report, the Fed had to make an emergency cut. That's not what the Fed does. The Fed doesn't react to the stock market. The Fed reacts to economic conditions. So, we will see data over the next few weeks and months that will tell us whether or not we're actually entering a slowdown, as a lot of people fear. If you look at GDP, gross domestic product in the U.S. went from 1.4% in the first quarter to 2.8% in the second quarter. That's not a decline. That is a rise, an aggressive rise. A lot of that was consumer spending. But there are predictions, if you look at GDP now, the Atlanta Fed's Fed tool, that GDP is going to slow to like 1.5%, 2% over the next year or two. Well, that's a slowdown, and that could be a recession indicator. But know this. The stock market doesn't always go down during a recession. It depends what else is going on, right? We were in arguably a recession coming out of COVID, but they floored interest rates and the stock market went off to rally 100%. So it depends on what's going on. Things are not always as they appear or as they used to appear, because market dynamics are constantly changing, and they're changing quicker than they used to.
Yeah, and it's not only the focus on the American market. Like, for example, Bank of Japan unexpected decision to raise interest rates show that the world is more connected than we thought before.
Absolutely, it's all connected. And when you start studying the markets, and hopefully a lot of your listeners are on that journey, because it's a great never-ending journey, you will realize the interconnectedness of markets and intra-market analysis. So, when stocks are falling, the obvious thing is, well, people are scared. Well, actually, if you look at the dollar kind of dictates what's going to happen to the stock market, right? So half of U.S. companies do business outside the U.S. Half of their revenue comes outside of the U.S. A strong dollar is tough for stocks, especially for those companies here in America that depend on overseas for a good chunk of their revenue. Watch the dollar very closely. It's connected. Watch the yen very closely. It's the safety trade. When people were running away from the stock market this week, where do they run? The Japanese yen and U.S. treasuries. Safer investments. But as soon as you see weakness in the yen, or as soon as you see weakness in other currencies, you can see the stock market over here reacting almost instantaneously. And you and I and our listeners and retail investors don't have time or the wherewithal to pay attention to those things. But if you are looking for signs to point to what may happen in the future, don't just look at market direction and volatility. Look at other asset classes and what they're doing, because often one leads to the other.
Yeah. And do you closely follow, geopolitical tensions in the Middle East and emerging markets and other markets? Do you follow geopolitical?
Yeah, I follow it because I'm a consumer of news, and it's part of the equation, but I don't make investing decisions necessarily based on them. Now, one investing decision that I do make and that I have made with my wife and our planner and others is around climate, right? To me, climate is the ultimate bogey. Bogey meaning anything can happen. Look what's happened. Well, you're not here in the U.S., but right now we have floods up and down the eastern seaboard. People could not get to Florida or anywhere south for the last 4 or 5 days. There are bags piled up in airports across the country. Families are stranded. That is a climate issue, but it's turning into a financial issue, right? So that is what we are trying to protect ourselves and our portfolios from the impacts of climate change, and it's very difficult. But I also make, and with my wife, a very distinct decision to not invest, this is personal, in fossil fuel companies. I don't want to invest money in companies that are contributing to that type of climate change. That's a personal decision I make. Does that have anything to do with tension in the Middle East? Does that have anything to do with, what's going on in China? Not necessarily, but I'll tell you this. Climate and climate refugees and migration is becoming an economic issue. Just look what's happening throughout the countries of Europe. Look at what's happening with the political rhetoric here in the US. People are fleeing their countries for various reasons, but a big one is climate, and that is only going to increase over the next 50 years because it's places in this world are becoming uninhabitable, which is driving people into major metropolises, which is putting stress on infrastructure, which is creating financial difficulties around the world.
Mm-hmm. So ESG is very important to you.
Yeah, I don't use the ESG label because I think that's gotten a little bit muddy. I mean, the environmental part of ESG, yes. The social part is important to me. The governance is also important to me. I would say I'm much more of a try to be a sustainable investor, SRI, or impact investing, which is not to say that, I won't invest in a Caterpillar or a construction company, because they're working in industry. It's just that I'm sensitive to sectors that may be contributing to that or also may be over leveraged or overexposed to the risks of climate change. Now you could say, well, what isn't? Every sector is exposed to it. And you're right. The banking sector underrates a ton of real estate, commercial real estate, residential real estate. The 30-year mortgage is based on a bet that you will pay off your mortgage in 30 years, assuming your home will still be there. Well, what if you're in Florida and you can't get home insurance, right? And you don't know you're in a floodplain if the next major rainstorm or hurricane is actually going to, take your home with it. The bank is underwriting your loan. They are at risk. So every sector is exposed to it. We're just trying to mitigate that risk and invest in things that don't contribute to the problem.
So now that you're mentioning sectors, some say that in uncertain times, investors should remain defensive and invest more in defensive value stocks such as healthcare, consumer staples, utilities.
Yeah.
What's your opinion?
Yeah, and if you looked at what happened on Monday of this week when the stock market sold off so aggressively, utility stocks did very well. They're defensive stocks. They pay big dividends, right? So you can do that. It's just very hard to do that as a retail investor unless you're paying very close attention. Back to your point about diversification. If your portfolio is all tech all the time, well, we have this expression that comes from Jimmy Cliff, the great reggae artist. The harder they come, the harder they fall. These stocks may rise. They may go up 100%. But as soon as there's a sell-off, they're going to fall and they're going to fall hard. And if that is the majority of your portfolio, you're going to feel it more than other people who are a little bit more diversified and have that all-weather portfolio, as Ray Dalio likes to call it, that is ready for any season. And then once a quarter, twice a year, at least once a year, look at your portfolio, rebalance it. Are you overweight in areas that have done really well? Are you underweight in areas that haven't, that could outperform? That's what we're talking about. When the stock market sells off, we have people like to say around here, not around Investopedia, but outside around here, don't look at your 401k. Don't look at your investments. I don't believe that. Look at it. Make sure you know what you own. Knowing what you own is one of the golden rules of investing. If you don't know what you own, then what are you doing in this game to begin with? You wouldn't go into a supermarket and just blindly throw things in the supermarket. Know what you own and how it performs under certain market conditions, and make sure you're comfortable with that risk level because it's your money. You're the CEO of your own money.
Yes. You said, look at it, even during corrections, even during market crashes.
Yeah, look at it. I mean, ignorance is not bliss when it comes to investing. Ignorance will hurt you in the long run. Now, if you're not a professional and you're like, I'm looking at it, but I don't know what to do. It's okay to not do anything too. If you sold on Monday because you were scared this was going to be a huge unwinding of the stock market, well, you've missed a 6% rally. And the biggest rallies in the stock market happen during its worst days, right? So right after a big drop, you get a big push, you get a big a rise usually. And if you're out of the stock market in those days, after a big decline, a correction, a 3% drop, you're going to miss the best performing days in the stock market that would help your portfolio get back to where it was and then grow from there.
Mm-hmm. You mentioned at the beginning that media, the headlines in the media mentioned crash, not correction. And we both work in the media industry, and we know how headlines attract readers. But things are actually changing with younger generation. They consume information on social media and are influenced by influencers. And 2 months ago, I was teaching teens about investing in high school, and they told me they closely follow influencers, and that if an influencer gave them a recommendation about investing in a certain stock or crypto, they would follow without doing their homework. That's scary.
That's dangerous.
Yeah.
But influencers, are also, and there are some very good ones out there. So we can't paint them all with the same brush. Yeah. But you really have to be careful who you follow and whose advice you take. And a good way to do that is to find out who you follow, who they're following. Who are they being influenced by? Right? Trace, right? The line of influence back to the source. If it's somebody who's just sitting in mom's basement trading stocks and getting lucky every once in a while, well, that person, they're more lucky than good. Now, everybody should have their own strategy and make their own decisions. And I get it. Like, I'm on Instagram too, and I'm on TikTok, and I did videos that, a lot of people watch and comment on, and I get that. What I try to do is speak to the educated investor. Understand how this works. I'm not going to tell you what to buy or what to sell. I'm just going to make sure you understand how it works, because an uneducated investor will get hurt if they don't know what they're doing. So that's our method of trying to do things. But there are people out there who will say, these 10 stocks are the next, Amazons. Mm-hmm. And you don't know if they're right, wrong. And you can make that bet if you want, but the blind following the blind is not a good recipe for investing success. So I recommend that you follow people who have pedigree, people who know what they're talking about, people like you that have experience in this world, and find out who they're following. And that's the best way also to build your own network of intelligence. What I do on X, formerly Twitter, I find that a great source of information. FinTwit is one of the best things that's ever happened to investors and financial media participants like you and me, because there's so many good ideas there and smart people in short bites that are making good points. But I follow the people who I respect, and I follow who they follow, right? And that has built me an enormous network. It's built me a source pool of people I need to go to if I'm writing an article or doing a story on something. But also, I want to make sure that I'm comfortable with the knowledge I'm getting or receiving from this person, because I know that they're actually learning from smart people as well.
Yeah, but the algorithms dictate what and how much should we consume. So if we see a clip of an influencer who recommends, 10 stocks to buy right now, you get caught in that algorithm. And
absolutely. And you don't know when they post, you may know when they posted it, but you don't know what's in their portfolio. You don't know what their strategy is. They could be long these stocks on this side and short the same stocks over here and hedging their position. So be careful who you follow. There's plenty of, every generation has it. We had it in the internet stock bubble days. A lot of analysts were making wild calls. You had carnival barkers outside the New York Stock Exchange, in the 20s and 30s. You had that outside the buttonwood tree when the stock exchange was formed 250 odd years ago. So nothing new here. Just be smart about who you follow and make your own rules that you can actually abide by in your portfolio. Don't just be emotional about it, because you will end up getting hurt. And when you get hurt, you know what happens? You don't want to invest anymore. It's like going into the casino. You go in there with $100, you play the slots or you play blackjack, you lose right away, and you want to leave, right? You don't want to play anymore. Now, investing and gambling are very different, but that feeling of loss is the same. Loss hurts us 3 to 5 times more than winning hurts us. So if you get out of the gate and you think you know what you're doing and you start to accumulate a lot of losses, you're going to drop out and you're going to miss the opportunity to build wealth over the long term. Gambling odds are far poorer than investing odds, especially if you're a long-term investor, and trading odds are even worse. So invest and build a portfolio that you can grow into over time and make intelligent decisions about. Don't trade, because that gets your emotions involved, and most traders lose money.
Now that you're talking about gambling, I often reflect on how our environment influences our investment journey or path. So you were born in US. I was born in Slovenia, where, we have a history of socialism. Our capital market is, just over 30 years old. US stock market is 200 years old, maybe 3. So yeah, it's not only
more than 100. I can tell you that.
More than 100, but it's not only where you're born, but also when were you born. So, for example, if you were 20 years old during the 2008 market crash, you might be a risk-averse investor in your 40s. And I don't know if you're 20 years old in 2017 during ICO boom in crypto market. Your approach to risk might be totally different.
Yeah. So I was born in 1970, right? And I've been through about 4 or 5 bear markets since then. But as an investor, My first one was when I was at Bloomberg, 1999, the internet bubble, right? I was hired by Bloomberg to actually cover the internet stocks. We were covering all those old school ones, pets.com and Lycos and Excite and AOL. And I was covering that. And sure enough, it crashed. And we're talking about a mega crash, 55% drop in the market, overvalued companies that were way ahead of their time. I was just talking about this on my podcast. Pets.com. You may not know what that is, but there was a company called Pets.com in 1999 and 2000. And what did they want to do? They wanted to deliver pet supplies to your home. That seemed like a crazy idea in 1999. But guess what people do today? They order from Chewy. They order from Amazon. Rarely do people go into a pet store and buy dog food anymore. They get it delivered to their home. There was also a company called Webvan or Peapod. What do? They delivered groceries to your home. That seemed nuts in 1999. We were not ready. I'm not getting my groceries delivered to me. I'm going to go pick it out. Well, 30% of people get groceries delivered to their home today. They don't even go into the grocery store. So ideas are ahead of their time, right? And sometimes valuations get way ahead of the idea, and you end up getting bubbles, and those bubbles get popped. We've seen it time and time again. I mentioned some of them. Internet stocks were one. Railroad stocks were another. Shipping stocks were another back in, the 19th century. Tulips are another example of that in Amsterdam in the 16th century. So if you're looking for manias where things got a little out of hand and investors got way over their skis, the history of the capital markets is full of them.
But for example, I have an 18 years old son, and his attitude towards risk is totally different than mine. So they're more like, embracing risk. They're not so afraid. So maybe this era, in crypto market that, they learned, on a steroid, everything that you learned maybe in 30 years, they learned in 10 years.
Yeah. Well, the first internet bubble, I was very long those stocks. I was buying a lot of those internet stocks because I thought it could go on forever. And I lost a lot of money. Cut to 2008, the great financial crisis. I was watching Lehman Brothers, one of the storied investment banks, here in New York. I was watching that stock go from 80 to 60 to 50, and I bought it thinking there's no way in the world Lehman Brothers goes out of business. Well, I was wrong, and I lost about $10,000, and I didn't have $10,000 to lose at that time. I thought, again, here's why I don't pick stocks. My timing is terrible. So I learned during that crash, but I also learned in 2008 that when things like that happen, the Federal Reserve and the Treasury respond to it by pouring money all over the place, lowering interest rates, and then either giving stimulus cash or giving cash to households. And what does that do? That ignites the stock market, right? Risk goes all the way up. And I backed up the truck with all the money I had in 2008 and went long, real long in the stock market. And that ended up being a super important decision that I made, and it set me up. But now I know how these cycles work, right? And I know how to respond when things get tough. And I also work with professionals that help me out. So I've been through a few bears, and it does shape the way I think, but it's also a part of the era. I have teenage kids. They are risk averse. Like you, your son is risky. My teenage daughter, 20 and 18, they're much more risk averse. And a lot of their friends are fearful of the stock market. But then there are some people that are like, I'm willing to risk it all because no risk, no reward. And they see influencers on social media with the Ferrari or sitting on the boat drinking, champagne, saying, crypto bought me this boat or whatever. And they want to be that. Or they watch Drake, bet a couple $1 million on a prize fight, and they watch his reaction. This is a very reactive generation that's growing up right now. There are two ways to think about this. You could say they're doing it wrong. They're taking too much risk. They're going to get burned. Yeah, they are. A lot of them are. But at least they're taking risk. At least they're understanding this very important 4-letter word, R-I-S-K. We don't get taught risk at any point in our lives. We have to learn it. When should I cross the street? Right? When should I take this job? Should I take this job? I want to ask this person out. We experience risk, but we're never taught how to evaluate risk. So the fact that they're getting into the market is a good way for them to learn risk, and hopefully they don't get burned too bad. They learn some valuable lessons, and it turns them into long-term investors who can build real generational wealth.
Can you give a final advice or a tip to our listeners in Slovenia? How to invest, where to invest?
Yeah. Well, we say this. The best day to start investing was yesterday. The next best day is today. And I don't care somewhat if the market is up at a record high or down in a tailspin. If you're not in, you're out. So you have to get started somehow. And when the market declines, like we had earlier this week or we had in 2022, and you have a long-term horizon in front of you to invest, buy, right? The stock market's the only store I know of when things go on sale, people run for the exit. If you're young and you have time and you have a little bit of money, that's the time to be buying, and always be buying, because the magic of compounding, the ninth wonder of the world, that's what Einstein called it, is unbelievable. And it doesn't happen quickly. So you have to be patient, right? You build wealth not over a week, not over a year, not over 5 years, but over a 10, 15, 20-year period. And then it's everything all at once. You're going to watch your portfolio double if you've been there long enough and been consistent. So get in the market, stay invested, buy through the highs and the lows, and let time do what time does, which is compound.
Thank you, Caleb. This is really great advice, and thank you for an excellent discussion.
Thank you for having me.
Evo, to je bil pogovor. Še enkrat, če imate kakršnokoli vprašanje, mi pišite, sicer pa nekak intro v 5. sezono bomo objavili kmalu, tako da boste videli, kaj nas čaka v novi sezoni, zagotovo pa ne bo dolgočasno. Tako da poslušajte Money How, ne bo vam žal in lep pozdrav.